a weekly chart, which is really ideal for gauging the length of a new bull market. Once we see our pivot signal, the high of the low bar, we've identified that. Of course, we can't lay any angles on immediately. In order to draw a little grid method like this, our angle can't be determined until we have our first top, which could be several weeks or a few months down the road. But the first thing we can do is get some of our projections up here by doubling the various sizes of our weekly bars, and these will be potential targets to expect for that first top. In this initial phase, we can always use 1/2 of the preceding week's low until we get these levels, and then we can put our stops at these various levels until we get to our first high. Once we have our first high, then of course we can put on our little Gann box grid here, put on our 4x1s and our 2x1s and our 1x1 angles, and the market will usually follow those all the way up, still respecting the principles of the doubling and the midpoints of the doublings. As we see here, a perfect high. It broke an angle, but remember, breaking an angle per se does not change the trend. And so it comes back to the support area, and then it goes up to the primary target area, and then has a 50% retracement again. If it would fail, it could still be caught by this angle down here. And note, at the top, it was running out of time because the first big time cycle was coming out somewhere in this area anyway. But the problem with this, of course, is we can't put our angles on. We're just going to use support and resistance initially using these boxes until we go a little higher. While the disadvantage of starting off on a long-term chart on a swing basis is not knowing where our angles are, we could use classic angles like a typical 45-degree or 63 3/4 or 75-degree angle from a protractor. But what we can often do to solve the problem is basically use angles from the previous bear market. We can use our offset angles to give us guidance about where the support and resistance should be in the new bull market in relationship to the old bear market. So we can see here, we can take an angle from the previous bear market down to the low, and the most primary angle, of course, is the 90-degree one. This will be a long-term bull market angle. Now, it may be a little bit down too far when we first initially start off here, and so we may want to try a 60-degree offset to get a steeper angle. But the 90 will at least tell us we're in a bull trend as long as that holds. And when it does eventually break over in here, we can still use another angle from the most recent high of the bear market and offset that by 90 degrees. And this is what usually happens. You'll get a break in a bull market, and it will go down to the second angle, and then you'll have one last rally back. So we can always use the angles from the preceding bear market to give us some offsets that will guide us that once we get into our trade, buying the high of the low bar and maybe looking at a couple of doublings as a trailing stop on a long-term swing trade, we can use these offset angles from the prior bear market. Let's look at a couple of patterns now and see if we can decide what we would be doing in these type of trends. This I've got labeled as a downtrend, and clearly it's a 60-minute chart, and we see it's down, lower lows, lower highs, lower lows. But what's peculiar about it is we have gaps on the upside, which show explosive demand for the stock. And then it dies out at a lower top, another gap up, another gap up, another gap up. But in each case, the gaps are coming up, and it either shows too many shorts, or it could be too many bulls that are buying an early decline in a new bear market, and the sellers are out there. But the gaps are a point to always watch. They come at the midpoints usually of the swings. So if you can define where the gap is on the upside, we can also project possibly where it would die out. So wherever the gaps are, remember, there's often a midpoint from where they originated to where it's going to die out. In this particular case, though, it does look like we're in a confirmed downtrend. Over in this area, we may be making a potential low, but there's still a lot of liquidation here. Most of the rally phases are 2 or 3 bars at most, even though they're explosive, which may indicate a lot of short covering or rumors around. but most of the rest of the time the market is down. So this is clearly in a downtrend, and in order to do something with it, we'd certainly want to find a lot more perspective. And if we look at the daily chart on it, we can see that that last downtrend was really this section here. And perhaps some of the gaps were all these people who thought they were in a bull market consolidation are guessing for where the bottom is going to hit. And we still haven't seen that. We have tested this 50% pullback area a number of times, and we're there one more time. And it remains to be seen if it would hold. But at least you're at a point where you could be building a base that if it turned up from here, it would be a small buy crossing the 1620 area, at least for a probe back up. And maybe for once this would be a big base. That would be the length of the base is the height of the move, and it would start another leg up. Note that I put on here the slope method, and I've converted under each of the next pivots. I put the slope back on, and we find that under the last major top, there is another slope forming here. So it's coinciding with the 50% level. If it was to break this low and the 50%, now the daily chart would start to look like the 15-minute and 60-minute charts, which would be in a downtrend, and it would actually be a short down here. Although I'm not certain I would put a short on, because if we really get even more perspective on it and we see the weekly chart, we note that you had a vicious bear market. We had a rally that made it up only 25% retracement, and it's basically been building a 6 or 8 month potential base in here, having regained our little angle right here. So even though it may be going a little bit lower, it's probably not a good short, simply because the bear market low, unless you really think it's going to be taken out, there's not a lot to be gained by shorting for a couple of dollars in here. So it's really more of a questionable pattern where you want to wait. If it turns up, it definitely would be a buy for kind of an A, B, C. That would take it up here from $15, $16 to $25. But right now, it's a wait and see type of pattern. Now, gaps do occur quite often, and here's another situation of a gap where we had 3 tops in a row. It had been in a strong uptrend, and then it suddenly gapped down. Then it had a big breakdown. It gapped up, but only came up to a lower stair step. Then it gapped down again, then another gap, and then another gap. So clearly this is the beginning of a liquidation phase. We have some tops again, which may be very similar to this, with either a repeat breakdown dramatically or a potential low, and they'll try and go up and close 1 or 2 of these gaps and perhaps head towards the midpoint. But here too, this is not the type of bottom you want to buy yet. You would buy a flat like this if it turned up and exceeded the highs. But you would not want to buy a little signal reversal bar down here simply because there's just too much overhead right in here to escape from. So the odds would be very good that if you did buy it here, it would probe the low a couple more times before you really want to see an uptrend. Now, if we get a little more perspective from the 60-minute, here's the daily, and we can see why it started to gap down. There was a support angle drawn, the circular arc, from the preceding bear market. And so from the leg down in the bear market, it was providing support, which was accelerating. It caught it here and accelerated up into a peak. And that peak seems to have been exhausted, and now we're breaking dramatically. Now, we did break back to the 50% and a little lower to where major support has been so far. So this could still be a potential uptrend, but I wouldn't want to touch it unless it got above this 50% level again and prove that once again it held. Otherwise, we'd be seeing at least a break to this level. But of course, a break to this level is the last gasp. That's the 90 degree from the last bear market. Sometimes you'll have a false breakdown and they'll quickly regain it. But either way, if you bought into this pattern, you'd like to see a break and bounce back above this level to buy it. Or if it turns up now, you'd like to buy it on strength too. I would not be buying this on any further dips in this kind of a pattern. Nor would I necessarily short it yet for the same type of reasons. You're at a known support area. You're a little extended on the downside, and there is potential support here for at least a retracement rally. So it's a stock that's really left alone. And a lot of times in trading, we have to leave a lot of potentials alone. Trading is really process of defining high probability trades and taking them and letting the stops work for us. And if they don't work, we'll get stopped out for a small loss. But this is not really a high probability trade as yet. It is a trade. You could buy this double bottom down here. It is extended. But I would prefer to set some odds in my favor that if I see an uptrend developing, and we have a couple little bars here going up over 3 or 4 days, and it exceeds this 50% retracement, you would have a much better chance of buying an uptrend, buying strength that was proven at this level. At least then we could forecast $29 and much higher. But right here, we can't forecast much of anything. It's a 50-50 bet whether it goes $1 higher or $1 lower, and that's not anything you really run a fool with. Now here's a chart of Goldman Sachs on a 5-minute basis, and I put on our measured moves now. We've first done our little measurements here of doubling, and we can see that the doubling targets were hit up here. So you've got a triple top pattern. It's pulled back a couple of times to the 50% level. And I put on the average correction, at least in the preceding week or two. And we see that where we are now, although we're at a double bottom again, we still have a considerable amount to go to get to another measured move. However, if they already get down there to a third time for a triple bottom, it would be still pretty dangerous to be long here. So breaking above this sloped correction line at the 50% level and regaining this level of the 25% area, this would potentially be a buy at this point, perhaps turning this into a consolidation. But right now, the stock can go a lot lower. It's not a great short because you've had consecutive bars in a row every single day. You could short one time at the 142.75 with a close stop. But here, too, it's more of a stock that it's probably better off left alone than taking a gamble on at this point. We could look at our longer-term perspective on this chart and see the dailies. And though the 5-minute chart can barely be seen on this chart, it's just a little flat. We can see that the 5-minute chart was basically in an area where it had rallied, and it was right up against the 50% retracement area from the prior bear market also. And it had topped out exactly where it should have. It pulled back to test support. It did not make it back to the top, and it broke. And I put some angles on here, as you can see. It bounced to the first angle, went up, and broke this angle. So it may yet have to test this angle down here or even another angle down here before we find any decent support. Now, in looking at the pattern, it could be a simple A, B, C, and this leg measured would be about the same if we get right to this angle over here. But again, the first areas of support are right here and then the test here. So you'd like to see this thing build a little more of a base up in this area above the 145, 146. At that point, you'd have higher confidence that it could turn the trend back up because the short-term trend is down, although it's within the framework of a pullback in a potential long-term uptrend that could go substantially higher if it was to regroup. So here we really want to wait a little bit to see, and we want to be a buyer of strength above this 145, 146. But on weakness, see if it doesn't hold this angle or see if it holds this angle for the completed measurement of an ABC equal legs down. Sometimes gaps are helpful to indicate where we are. If you were looking at this today and wanted to know if you should buy it or sell it, clearly it's been in a downtrend. But if we put on a wave count, we've got a 1, 2, 3, 4, potential 5 wave. So usually at the end of 5 waves, they turn up. And if we put on our little retracements, we can find out that the 50% area, assuming that this is going to turn out to be a low where we are, we find out then the 50% went right smack through the middle of a gap and caused a top over here. And the 25% level came through here right in the middle of a gap and caused a gap over here. And then up here, if we split this quarter into eighths, we find out that basically in the middle of that range, there was a gap. So far, the middle of the gaps are lining up saying that, yes, this will be a significant area down here. So it could be a 5-wave low. So I'd be looking very careful now for a signal reversal bar that regained the previous little lows in here. And if we got this thing toward